frame to trade on. This video will help you to decide which time frame will suit you the best to trade from. In this video, you will learn what a time frame is, the characteristics of a short-term, a medium-term, and a long-term time frame, and the different types of trading based on these time frames. Let us start by explaining what a time frame is. A time frame refers to how long it takes for each candlestick on the chart to form. So, on a 5-minute time frame, each candlestick on the chart would take 5 minutes to form. On a 30-minute time frame, they will take 30 minutes to form. During the first 5 minutes, the candles on both time frames look exactly the same. After 10 minutes, however, you will see another candle has formed on the 5 minutes chart, but on the 30 minutes chart, it is still the same candle showing. It is important to understand that a 5-minute time frame does not show the price action over a 5-minute period, but rather each individual candle on the price chart takes 5 minutes to form. Time frames are divided into 3 groups. Every time frame below 1 hour is generally considered short-term. Anything 1 day and below is considered mid-term, and anything over a day is considered long-term. You do not need to monitor every time frame to be successful. The time frame traded on must match the trader's personality. For instance, someone who is impatient and wants fast action should trade short-term time frames. Someone that is more patient and has the time to watch the markets might want to trade the mid-term time frames. Whereas someone that only wants to look at the markets every now and again will be better off trading long-term time frames. No two traders are alike, and you should trade a time frame that suits you. Now let us explore a little bit further into the characteristics of the different types of trading and the time frames involved. The most extreme form of trading the short-term time frames is scalping. Scalping is when you watch very short time frames and hold positions for a very short time. It is usually fast-paced, stressful, requires complete attention, and active markets. It is traded on the 1 to 5 minutes time frames. The next trading style is day trading. It can require more market analysis and is slower than scalping. Economic developments must be followed as they will influence the market throughout the day. The trades are opened and closed the same day. Swing trading takes place on the longer-term time frames. In swing trading, positions can be held for several days. A trader must be patient and disciplined to wait for a target price or a stop loss. Because of the higher target prices and bigger stop losses, spreads do not have such a large impact on trading results. Traders do not need to monitor trades all day. Position trading is a long waiting game, and positions can be held for several months. A position trader will use a combination of daily, weekly, and monthly charts to make a decision. Fundamental analysis plays a key role. Technical analysis is used to fine-tune entries. That brings us to the end of this video on which time frame to trade on. So far, you've learned that there are many different time frames to choose from, and which type of trading is best for you will depend on your personality. Short-term time frames are commonly considered to be less than 1 hour. Medium-term time frames are the 1 hour to daily time frames for swing trading. Long-term time frames can be considered to be daily, weekly, or monthly. You also learn that scalping is fast-paced and is traded on the 1 to 5 minutes time frames. Day trading is another short-term approach in which trades last less than 24 hours. Swing trading is for patient traders, and positions can be held for several days. Position trading is another long-term approach, and positions can sometimes be held for several months.